Hey guys, this is a market update. This is an absolutely pivotal time for the entire market right now, not just Bitcoin. We have the CPI figure that is coming out next week. And in this video, I want to go through all of the macro data, economic data, employment data. How is this all feeding in? Where are we in this cycle? Can the Fed and other central banks actually start to ease off? Will they be forced to ease off because the economy is getting so bad? Or do they have to actually even more get aggressive and start to potentially raise rates more than what the market is pricing in right now? This figure that's coming out on the 12th of December is unbelievably pivotal. This is going to tell us everything about where the market is going to go short term. So let's look at what this figure is actually going to be and how central banks are starting to play this. Right now, Bitcoin is going to, in my opinion, trade pretty much sideways up until the 12th of December when the inflation figure comes out. This is the US CPI figure. 17,000 is a nice round number to be trading around right now, still firmly within a downtrend. We do have this around 15,500, which we could easily touch again if this CPI figure is higher than expected. And I expect actually new lows to be coming in, certainly if this figure, doesn't play ball. So for right now, we're still firmly within a downtrend, but I think we're going to be trading sideways into the 12th of December. Just quickly, if you are a trader, deposit bonus on Bybit up to $4,000 if you trade. If you're an investor, you can get commission-free spot trading right now as well, so you can buy your crypto on there and then take it out to your spot wallet. Link in the description for that, but I want to get onto the real economic data here as well. So we'll look at firstly the ISM manufacturing surveys, what they call the PMI. Now there's manufacturing and services, and anything above 50 is growth and below 50 is contraction. From the Federal Reserve's point of view, they're kind of wanting something around, contractionary, so 49, 50. Anything under that is obviously an extremely poor economy in a negative territory, which is actually not good for anyone either. And so there's this fine line that has to be trodden. So manufacturing is in contraction right here. Now, this is deflationary, of course, which is actually what the Fed wants. And so when you're looking at this is telling us that, hey, maybe the Fed doesn't have to get so aggressive in the future. And that's actually, on the flip side, actually quite good for markets who say, hey, we don't have to price in as many rate hikes, which ultimately will lead to a much harder recession down the line. So in terms of manufacturing, what we're seeing here is new orders contracting faster. So that's actually, deflationary, or at least not inflationary, which is seen as a fairly good thing until it gets much worse. Employment is contracting. Production is growing. Again, this leads to maybe inflationary pressures, coming off a little bit. We have prices decreasing, backlog of orders contracting. So this is showing essentially in the manufacturing sector right here, it's contracting from growing. This is exactly what the Fed wants. And actually at 49, it's not terrible, right? So right now you can see this coming off huge from 2021 all the way down to now actually contracting a little bit. This is okay for now, but obviously if this gets down to massive, 45, there's a massive problem. That's what the Fed definitely doesn't want. And that's what we don't want in terms of asset prices and everything else as well. So what ISM actually have here is that the over economy is growing. And I'll show you why. It's because this is the services sector PMIs. And obviously most of the economy, especially in the West, is mostly services, especially the States. This is showing growth and very healthy growth within the economy, which doesn't really fit into what the Fed wants and what the market wants, which is this coming way down to more like 50 instead of 56. So what we can see here is that business activity is growing, new orders are growing, employment is growing. That is all completely contrary to what the Fed wants, which is why they're raising interest rates and why they're trying QE, taking money out of the system, because they don't want this going up. Now, this actually raised, right? It actually got, further into growth territory in November, which spooked the market and why you saw the market come off the last few days. Now, this just may be part of a downtrend, right? There's no straight line anywhere. This just may be part of a downtrend, which it seems like it is as well. And so what the Fed wants really is just a nice slow downtrend to around 50 and then kind of stopping there. But of course, the Fed has a hammer, and usually by the time it gets to 50, it's already on the way down to much lower than that anyway. So the economy is growing, and really what the market wants to see here is this actually coming off a little bit further. Every time this ticks up, this is bad news for the market, right? Good news is bad news right now for this type of figure, because what it's showing is that the Fed's interest rate hikes kind of aren't doing the job. Now, all of this is way lagging. This is coming months and months after interest rate hikes that have happened previously. And so this is a lagging indicator. And so definitely not the only thing to be looking at. In my opinion, this is still coming down and within a downtrend. And so for me, it actually isn't a bad thing, but short term, the algorithms in the market are going to trade these things. If this ticks up, then the market is probably going to get sold off, just because then the algos are saying, well, rates may be a little bit higher for longer, right? So that's all traded just by the algorithms. Now, another piece of data that to look for is actually the S&P PMIs. It's this, they measure the same thing, but they're actually getting a different different score here. So according to S&P, they actually think that the economy in the services sector is actually in negative territory already. According to them, it posted 46.4 in November, down from 48.2 in October. So who to believe? Do we believe S&P, who are actually saying we're already in a recession essentially? Or do we believe the ISM survey, which is showing that we're still in growth territory, albeit coming down? Well, a midpoint of these two, between 46 and 56, let's say around 50. No growth and no contraction as well. So we're right in a stage now, and as you can see from this Nomura report, they are saying very, very slight contraction. Now, the market may be starting to think here that, is this potentially the start of the contractionary phase and another contraction? We had one earlier on in the year. Are we now going to be getting one potentially starting now, an actual recession? Well, again, some of the other figures are showing that that isn't the case, but all of these figures come out at different times. The growth figures are lagging, and the last thing to fall, without a doubt, is jobs as well. So we'll look at these figures as well. Now, in terms of the stock market, and I know this doesn't really have much relation to Bitcoin, but the stock market, and what I saw yesterday was that the stock market is now at 17.5 times earnings. Usually the stock market over the long term prices in 15 times earnings. So what we're saying here is that after this bear market rally that's just occurred, we are now, meeting this downtrend resistance once more, potentially with some pain to come, because it looks like, the economy is starting to tick down and starting to slow its growth. And that means that earnings are going to start to come down as well. So why is the stock market pricing in 17 times earnings? Earnings will be coming down, and so the price you pay for them should be coming down as well from that uncertainty. So from here, what I'm seeing is that the stock market is basically pricing in perfection right now of a low inflation figure coming in, and also essentially a soft landing with a very small retraction, if any. This is potentially dangerous, because if that doesn't work out, you could definitely see us getting rejected and coming off and testing these lows again. I don't think we're in the stage right now where we can declare victory of anything. And actually, this is going to depend on what the CPI figure is when it comes out next week. It really is the inflation figure that is key here, because a lot of the economic data is showing all of these downtrends. But unless inflation actually comes down, then the Fed is not going to care about any of that. And it's going to send the economy into a deeper recession, because that is its mandate. And jobs are going to be let go because of that. So this is the inflation rate. And again, what I see here is a downtrend, no doubt, from the peak mid this year. And the rate of inflation has been coming down, now at 7.7. And as we can see, we are forecast for 7.6 on the 12th of December figure. Hopefully this will be coming in much lower. A beat in like the low sevens, 7.3, 7.4 would be absolutely brilliant for the market. It would show us that inflation is coming down at a much faster rate, and that means that actually the Fed doesn't have to be as hawkish. Now, they're going to raise 50 points in December. They've telegraphed that. But what happens and what is being priced in now is what's going to be happening at the end of January, beginning of February, when their next meeting is. Right now, the market is pricing in a 50 points rate hike in December, and then actually a most likely 25 in Jan-Feb. Now, if this inflation figure is bad, that's going to get repriced probably to more like 50 basis points. And so you're going to see a real sell-off in risk assets as fixed income is repriced, and so it reprices those risk assets as well. Other parts of the economy are showing a huge recession, essentially. Housing is one of them. As you can see, the fastest housing slowdown on record, even worse than 2008. You got 2004, 2015, 2022, the absolute worst housing recession ever. You saw one of Blackstone's REITs actually stop redemptions. That was because there's no bid in the market, right? So Blackstone have a lot of real estate investment trusts. They have single family homes and everything like that. There's no bid for these homes. People want to get their money out. They can't do it. This is the start of potentially something worse, where the market seizes up because the rates have gone so high so fast, markets start to seize up. And so you're seeing all of this stuff tick down. This is the mortgage rate right here. Again, topped out above 7%, just starting to tick down. You can see another inflationary pressure that was big during the pandemic was the used car bubble. That's completely gone now. You're also seeing rents as well. And you can see that usually at this time of year, the rent index does drop. But what you can see on this occasion in 2022 is that the rent index is dropping at a much larger rate than previous years. And so again, this is a massive constituent of CPI, one of the biggest. And so this coming on is very, very good news for CPI. Again, a soft landing would be CPI coming way down, core PCE coming way down, but having the ISM services and manufacturing stay as near 50 as possible without getting into the 40s, mid 40s, low 40s, which is a disaster for the real economy and the stock market in general, as well as those earnings come down, people get let go, and Bitcoin is not going to fare very well during that, simply because I think Bitcoin is a financial index. So it indexes the financial health of everyone that owns it, which are normal people. And if they are not doing well, then there's no way the price of Bitcoin is going to reach new highs, even if interest rates start coming down to actually kind of temper that slowdown in economic growth. So it's extremely difficult right now. This is one of the key metrics right here, which is the labor market. And again, it is just starting to tick over. So what we're seeing is all of the inflationary data, all of the other data, the jobs data, manufacturing services data, mostly showing a downtrend. The market can come off as much as it likes, but if inflation doesn't come down as well, then that's really, really bad news. That's why the CPI figure next week is so important. Also, this fact as well, the S&P hasn't bottomed before a recession since World War II, and it looks like we are really not there yet, right? Looks like the data still has to come off in terms of that recession, but a soft landing, as the Fed wants, is, not a recession. This is where the Fed funds rate is right now, about 3.75. This green line is where the market is pricing in right now, around 4.5, which would be a 50 points raise in December, 25 points at the end of January, start of February. Now, if the inflation figure comes in hot, this is going to get repriced upwards, and that will be pain for markets. So where we are with Bitcoin right now is, I think, just a consolidation here, but this CPI figure is probably going to tell us the direction of travel for the next few months. The December meeting from the Fed will come out. They'll raise 50, but it's really what they're saying about the next meeting, right? Because they've already said 50 is going to happen in December. So if this figure comes in very soft, then maybe they can ease up on their rhetoric a little bit. If the CPI figure comes above expectations, expect Bitcoin to definitely test lows right here, because there's just no end in sight in terms of the Fed having to be even more hawkish. And we're seeing all of the economic data start to tick down right now. Remember, all of that is data that happened in the past, and so by the time the Fed flips, things are going to continue to get worse in the economy. All of this takes time, and so very, very difficult to time market bottoms. Like this tweet says, the market hasn't bottomed before a recession since World War II. What usually happens is that the Fed will flip. The market may actually start to start pricing in growth in the future again, but the economy is still going to be coming down with all of that data. So extremely important next week CPI on the 12th of December as to what that is. It absolutely must come down significantly for markets to actually start to find, potential strength here. But I think during this time of uncertainty, the next few months is absolutely pivotal in terms of how high for how long the Fed has to be. Bitcoin is just not going to enter a bull market anytime soon, in my opinion, because Even with a softer Fed, that means the economy is actually getting a little bit worse. Bitcoin is a financial index, and people's finances are not doing too well right now in comparison to other times. And so we're not going to be entering a bull market anytime soon, in my opinion. But as a long-term investor, these are probably areas that you dollar cost average and try to get better prices for your Bitcoin versus the bull markets anyway. If you're an investor, get 0 commission on Bybit right now, and then take that out into your wallet. If you're a trader, you can get up to $4,000 as a deposit bonus as well. Hope this video helps. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.